So today I'm here to go over a trade I took yesterday, and I should have journaled at that time, but I didn't. So I'm here to do a review. So I was positioned at the value area. I was positioned at the value area where the room was built. They push a price readout. So price came to the level. We dropped off. We left the gap to this low. Price buy and the boutique is our gap. Price came up, left the gap to this top here. So as price was coming up, I was looking forward to see price break this level, to fill this gap, to take this liquidity over here and break back in, and then look for continuation to the downside. However, so I was positioned at this area. So now the price moved into the level. We had this strong impulse. We entered into this big correction. Impulse, correction. Within that correction, that 1, 2, 3 price for the and this big impulse and then correction, continuation. We had another big impulse, correction, continuation, and then this weaker correction going into the level. This is the 1, 2, 3 driving price, and the 1, 2, 3 driving price, and this is when we extend this, it is bearish continuation. So impulse, correction, continuation, and I think I was positioned here as well as an override. So why I deleted this was because I have my overall value area at this point. Here is an inflection point. We have a gap to these highs. So this is the ultimate level where if we break above and we break back in, I can see here we are going into position and value area, impulse, correction. Within that correction we get impulse and a bigger correction. So we are looking for impulse, correction, continuation. We left a gap, we are failing. 1, 2, 3 driving price. So let's look at the sequence. Okay. So after position, we went into this level strongly, impulsively, and they rejected. So this is the market washing or traders out. So we break above and we break back in. This is the signal price action, and this is the confirmation price action. So I wait for price to break above, break above and break back in with this wicks. So this is the reversal candle shift. And after we get this strong momentum, I jump to the 4-hour. So now I identify the major players that are likely to step in. And I measure me clues in any me gap and I have feeling. Then my 1, 2, 3 driving price. Then my impulse correction model. And price any break high and every break it back in. Now if we are positioning also at value area, so this is confirmation for me to get involved in the market. So my bar say my bar for one when you say price had drop this first correction, which is first continuation. Now price for me another correction was see. So this sequence is healthy. I started another sequence be view. So in 1, 2, 3, 4, 5, 6 candles. 6 1 hour candles. So 6 hours. Into me buy and price for around I. So 1, 2, 3, 4, 5, 6, 7, 8. After this 8th candle, because I would say either 6 to 8. So after we now 4-hour structure, so I said you break it back in. So 4-hour structure not happening. You have to wait for at least 6 to 8 1-hour candles. 6 to 8 1-hour candles means like 8 hours or 6 hours. And then I jumped in right here after this strong momentum to the upside, and I position my stop 30 pips above the highs. Why? Because if here is the level where all this sell-off began, so price can come back to tap into this structure and continue to the downside. I don't know. Okay, so this is the 1% model. Yes, the 1% model. It means when price move more than 1%, so 1.5%, I will move my stop loss to break even. To take risk off the table. And it is not just 1%, it is our structures too. If you move 1%, then I say you make it structures. I'm not going to move my stop loss now, because that one adds risk. It makes my trade risky, more risky. So this is my first target. Because this is where we started this strong impulse to the level. So volume was also built here. Then we say I will position myself there and look at how far I can ride this wave. How far I can ride this wave to this lows And if you continue, you go. This is 4%. You continue, then you go. Because when you look at the structure, we have a potential to move 90%. This is just the beginning of the move. So if you are to move like 90%, you will lose. Our target is around here. Because all the gaps have been filled. So if you are to move, there's a high chance that price will move till you get to 90% of this structure. So this is the first target. So okay, I've taken the trade, but the question is it a high probable setup or a low probable setup? 2. Does this trade meet my plan? 3. Is this trade higher in risk or lower in risk? Yes, this is the third question. So how did I answer this question? How did I answer these questions? So first, the first question was, is this a high probable setup? And if before I will know a high probable setup, I have to be aware of what a high probable setup is to me, or what it means to me. So to me, a high probable setup is one. That's how the base of this model. The PSE model. This is the base of this setup. So we have my positioning, my sequence, and my entry. This is the thought process of the backbone of the strategy or my system. This is the tools that I use to analyze the markets. This is like my pair of lens that I use to view the market. This is the base plan, the foundation of everything. So a trade that is positioned well, and there are many elements to position, and a trade that have a healthy sequence and entry. So this trade, where is it positioned? So here is the position of the market. It is positioned at correct value areas. What was it? Volume, every day was near the drop pay. already another bullion, then you drop it. Impulse, strong impulse to the downside. Now price started to the upside. It do have a generative volume and continue moving to the upside. If I tap into the zone now, free buying, we came to the downside, we left the gap. Price buying the bar back in the reference gap. So as soon as we cut up into unfairly. And price move strong impulse into the level. Nearly a leaves a gap in a drop in your forming. Strong impulse correction. We are looking for a continuation. And now price echo correction is breaking above this structure, which is a confluence of price breaking above, because price is consistently breaking highs and breaking lows before the big moves. So positioning near will be a position where I think the bigger players will step in the market. So if you break above this structure and you break back in, this is a confirmation. But this at the later stage, but it is a confluence. What I'm talking about right now is this gap. So before the big moves, we need to fill the gaps. We can look at a similar example at the lows here. We had 1, now 2. We left a gap to the low. Price went up in a quantity to take liquidity at these areas and then buy another small tiny liquidity and then drop it to take that gap in the one thing and break the low. You find some you move it to the upside area strongly, and then also you could leave it up. So they are happy when I see the same thing as also happen when I see a leave up in a bar for. You will tap into the zone near drop in a Korea into a break 1, 2. You are looking for say the third one. We break it back in 1, 2, 3 drive in price. Into gap. Never fail a gap on the first confluence. A position at value areas where there is volume. Any breaking above second confluence. Any breaking back in, there is signal price action and confirmation price action. And here, theory no know. The answer expanding channel way. So expanding, and I see override, or there is the second touch. So maybe there's too much momentum coming into this zone now. They basically pushing to break below. So here is an override. This is another confluence of breaking the override and breaking back in. So 4 confluences with this expanding structure and this break back in. So expanding structures at a value area are reversal structures. But when your price is continuing the move and you are at the middle of a structure and you form expanding, it is likely you will continue the move. But when we expand into a value area, we likely reverse. So at the value area, we will be looking for intervening at the third touch at this zone to continue the move to the downside. But we didn't. That's why we have the override. To break the override, they break back in. And within the expanding structure, what we have is this strong impulse. And then we had the volume being built. This correction. 1, 2, this is the third touch. Price broke above and broke back in. This is the bearish continuation. impulse correction, continuation within a bigger expanding reversal structure. Reversal structure. Impulse correction. We are looking for a reversal. So the position is good. And now the signal price action and my confirmation price action the ABA. And then the happen with daily ABA. It's a signal price action confirmation. So what I jump P in. Now the position is good, the P is down. So yes, I'm defining the new San American. This is a this is a hyperbolic setup. So the P is thick. So positioning, tick. Let's look at the sequence. What is the sequence? The sequence of the market is how the market unfold. How the market unfolds. So with the inception of the market, what you see on the higher degrees happen on the lower degree. So you have this smaller impulse within the correction and a bigger impulsive leg. Then you have a bigger corrective structure and then continue. And you see that this correction you had wasn't just a correction, it was just a footprint within a bigger impulse. So you count all of this as impulse and this will be your bigger correction. And the continuation, and within the continuation you will have corrections in it. The corrections, or yes, the sequence, the corrections are volume being built to carry price from point A to point B. So these corrections are volume generating so that price can get that liquidity to move to wherever it is going. So why we need to tap into these structures and break above and break back in is for volume, for price to grab liquidity, so that we can move. So when we tap into this zone, that's the move we are looking for. Is it will start off small with a smaller correction, and then we get progressively bigger to the downside. So higher up in the run, we are not looking forward for big pullbacks. So we are looking for this is why I thought about the 6 to 8. The 6 to 8, but that is at the entry part. This is the sequence. So the sequence is now we've pushed back in the market. This is our first correction. So we'll look at it in more details on the 1 hour. This is our first correction. This is our second correction. And I believe this is our third correction that's forming. So it can be like activating about the tapping. Then we continue to move. And we do another volume. I can't anticipate all the variables, but what I can do is follow my system, use the tools to analyze where the bigger players are likely to step in, so that this setups are not isolated, I will know that they are backed by the higher time frame market flow or money flow in the market. So what I will do is I will, after I identify it, so this is a 4-hour continuation. Yeah, drop it, correction, continuation. But I say any part of daily before I make training for the continuation. So here I won't get that move because it's certainly break it back in. That's not my confirmation price action. What now at that moment was this 4-hour structure. It was, let me go to the analysis. It was around 17:00, 5 o'clock there. Now then they are watching. So I had 1, 2, 3, 4, 5, 6, 7, 8 candles, 8 1-hour candles, which is the second continuation of a move now happen. So 8 candles was enough for me. 8 hours was enough for me to get involved in the market. And at that moment, I jumped in. So this is the entry. The sequence is good, and now I've got entry. So this is a high probable setup. I can see this is a high probable setup. This is a high probable setup. So I've answered the first question. The second question was, does this trade fit my plan? Yes. So I left other variables in it with the patterns within patterns, the middle structures, and all of that. But I can guarantee this is a high probable setup. So that this trade meets my plan? Yes. What is the plan? So the plan is either I will take a 1, 2, 3 continuation, or I will take 2 touch and price will count down, number better being then we look for continuation at some of this. At some of these highs. So is this a 3-touch continuation or a 2-touch continuation? Let's look at it. So here was where I was positioned for price to come back to tap into the structure so that I will get a 2-touch continuation. But I didn't. May 2-touch, and I saw say you move, so I got in So this tree doesn't fit the plan. This setup doesn't fit the plan. Although I am positioned well and the sequence is good and the entry is a typical entry, but it doesn't fit the plan. So this sequence I have to have a 1, 2, 3 structure or a double structure, 2 touch. So if price ever for me we see, then we come to this this one will be more confirmed because then say 1, 2, 3 tap into this structure to draw. This is more confirmed. Maybe a middle structure view, so that you look at it as a completion of a pattern to continue to see and drop it. Or price ever streets because in that impulse correction. Twice if you have street to tap into this one. Into you ever tap into a zone a bit you want to keep risk entry or top passing or a bit you are trying for first continuation to continue the move. So let's say work up first time. So highway and take highway. So we'll be likely say price about we take this high, then equal to this high, and then correct before we name in third one and third high to break or to tap into this structure. Then taking and risk entry. Or you take reduce risk entry or insurance entry, you take a risk entry or reduce risk entry within the insurance entry. That's the plan. So my first time to maybe a second. So let's see. So it doesn't fit the plan. It doesn't fit the plan. Something like this. That one will be more confirmed. So as it doesn't fit the plan, does that make this trade higher in risk or lower in risk? Higher in risk because this is where I'm positioned. It is likely price will come to break about this structure before we will move. I don't know exactly what will happen here, but it carries more risk. If I have the 1, 2, 3 structure, it will be less risky. Or a 2-touch continuation, it will be less risky. So now it is positioned very well. The sequence is good, like it is a high probable setup, but it doesn't. This entry hasn't matured yet. So I'll wait for it to develop. Whilst I'm in this. So while I'm in this, what I have to do is to manage this setup, because it can happen that price will continue to move to the downside. It can happen. I don't know, and I can take off. I've taken off my position at this structure, and price will continue to drop like 10%. I don't want to screw with my edge. At that moment, I saw an opportunity, and I got in. Fair enough. Right now, I'm in a position. It is not that I have problem getting out of losing position. This is not a losing position. I'm in the trade already. So now I have to allow the setup to play out. What I have to do is to manage. So 1%. At least 1.5%. So I'll take risk of the table, so that this setup will play out. Yes, so this setup will play out, and we see continue the move. So this is the setup I wanted to go over. So the DSY, next week, so position. The volume being built to move to the outside. Below, break back in, continue to the outside. So this was the original trade idea, and this my impulse, this correction, and this correction I had the middle structure, impulse, correction, continuation, looking for continuation to the downside. So had this setup. Okay. I had a setup. Position at the lows and at the highs. Second low. Yeah, where volume was triggered. So we had this sharp move to the downside. Volume was moving to the downside. Price, well, we take this out, it's really near body volume. So, well, if you following the lessons, you see, we have this one at inflection points. We have big corrections at inflection points. So you have this corrective structure and continue the move. And now you're having a bigger corrective structure at this inflection point. Impulse correction continuation. And we return into this corrective structure. So I was positioned at this lows here. When price came here, I was looking for it to continue the move. I think it was something like this. So I had this impulse, and I was looking for price to come back to tap into this structure. So that you trade from this level to move to this downside, because price it will maybe it will not be likely price will tap into the structure to give us the third touch. So what I saw was price had this structure at this area here, and a drop here. Smaller correction continuation. So I was positioned at this area here. Same area, even 1, 2, and third one, and continue the move. And continue the move to Ahazi. So I had this structure. Price by any week in a week back in. But at the moment, when a week back in, I'm jumping in a code daily. I saw this. Okay, let me put this thing there. Okay, let me go back to the 4 hour. So at that moment, when we broke back in, I saw this structure, and I saw a reversal model. It is a reversal model, and here is the footprint. So it was likely price will So it was likely price will come back to this low before we continue, or come back to tap into this low before we continue to move to the upside. That was my thesis. So this was the structure. We broke below, move back in, and move strong impulse, and we had this correction. So impulse, I was looking for correction and reversal to at least this lows here. So the reason I made kind of some buy move, I got in the buy move, and yes, there was an expense. So I got in the long move. I think around somewhere here or something like that. I can't remember, but I got in on a long move. So when I was out of the tree, I realized this was the reversal, and we had a gap. 1, 2, 3 driving price correction, first continuation, and we move. So, but this would have been a low risk setup, because this one there, it will be a high risk setup. Why? Leave a gap where I see. So leaving a gap where I see makes it a higher risk. Although we move impulse correction is a reversal model to reverse the structure. But this is a lower in risk, because this reversal is testing the back end of this. So you can see, yes, at the back end of this structure, which makes it lower in risk. And this one will also fit the plan 1, 2, 3 model on the 4 hour. So this is a structured 4 hour flag, and I can take what do you call it, risk entry. I take risk entry. So, and then you see how far you can take it. Here is 4%. By risking 20 pips, placing your stop above the highs. This is a risk entry. You will get 20 pips. This is the insurance entry. Here's an insurance entry. Continue doing So this is the structure that calcium can take. Could have been great. So now, for me, I drop. Yeah, you ever drop power with the keyboard, I continue moving. So that's it for today.